So you handed us a set of sources that detail one of the most explosive, most aggressive new price targets we've seen on Wall Street in a while.
It's a big one.
It really is. So today our mission is to cut through the noise, figure out if this is just, promotional hype, or if the underlying fundamentals of Kratos Defense, that's ticker KTOS, if they genuinely support this stunning valuation.
That's right. And we're diving deep into the analysis report that just dropped from JonesResearch.
And when you look at it, it's highly energetic. It reads less like a standard corporate analysis.
Oh, for sure. It's more like a detailed case study in what they see as a huge market mispricing. The central claim is incredibly bullish.
And the implied message is pretty clear, isn't it? The market is basically asleep at the wheel on Kratos' future.
Completely. And JonesResearch just delivered the wake-up call.
A wake-up call quantified by a massive number. They initiated coverage with a strong buy and a street-high target of $150.
$150, yeah. And just for context, Kratos was trading around $92 when this hit the wires.
That's nearly 60% upside being called for, like right now. That kind of bold projection requires, it's more than just optimism. It's a fundamental reassessment of the entire company.
Okay, let's unpack this, because setting a target that high, it's a declaration, it's conviction.
Right.
It's essentially saying the market has underestimated Kratos' true worth by, roughly $58 a share.
So let's start with the catalyst then, the initial shockwave. Tell us about the analyst and why this 150 number is just so jarring, especially in the defense sector.
Well, the news dropped on Monday from JonesResearch analyst Josh Sullivan. And, in the defense industry, analysts are typically cautious.
Very conservative.
Extremely. They value companies on long-term government contracts, stable, low single-digit growth. Before this report, most of the consensus analysts, they had KTOS parked right in the $90 to $100 range.
The safe zone.
Exactly. The safe zone. They were modeling Kratos like a traditional, maybe slightly niche industrial defense stock.
So when Sullivan comes out with 150, he's not just tweaking his model.
No. He's arguing the market is fundamentally misunderstanding what this company is.
Okay.
That 150 target, it just shatters the ceiling. It implies a complete shift in how the company should even be valued. It forces every other analyst to look at their models and ask if they're using the wrong multiple.
Because if its peers are growing at 3 to 5%, they get one kind of multiple.
Right, a low price to earnings multiple. But if Kratos is about to deliver 15 to 20% growth, that PE multiple has to jump substantially.
Which shifts the valuation closer to, a high-growth tech company.
Precisely. It's a valuation argument dressed up as a price target.
But what's the thesis here? What justifies this massive leap? What's the core catalyst that Sullivan is betting everything on?
What's fascinating is the focus on speed and scale. Sullivan's whole thesis is laser-focused on what he calls steep revenue ramps, specifically for 2026.
Okay, so it's a timing thing.
It is. The core belief is that the transition of their flagship platform, the Valkyrie drone program, the XQ-58A, is about to go into full mass production.
But the market knew that was coming, didn't it?
It did. But Sullivan is betting that the velocity and the volume of this ramp-up will be far, far faster and larger than anyone else is modeling.
That kind of conviction, betting on speed in a sector known for, bureaucratic delays, that requires some serious backing.
It does.
So let's pivot to that. The report outlines what it calls the 3 explosive growth engines.
And you really need to see these as interlocking parts, each one reinforcing the others. They argue Kratos is moving from being a development shop to a full-on production powerhouse.
Okay, so let's start with engine number 1. The Valkyrie goes mainstream. We've heard about the XQ-58A for a while. It's a centerpiece of the Pentagon's vision. But what's the crucial new detail here?
The detail is its new official bureaucratic status. The report emphasizes that the U.S. Marine Corps has officially designated the Valkyrie as a program of record.
And for you listening, this is probably the single most important operational detail in this whole investment case.
It really is. This isn't just jargon. It's a profound operational shift.
So moving from R&D to program of record, what does that actually do for the revenue model? Why is that such a game changer?
Because it changes the company's trajectory from maybe to guaranteed. When a project gets that designation, it's not an experiment anymore. It's not funded by these temporary, unpredictable R&D budgets. It becomes a dedicated, secure, and mandatory line item in the defense budget.
For the foreseeable future.
For the foreseeable future. It guarantees funding stability, and most importantly, it gives them the green light for true mass production.
And mass production in the defense world means high volume, predictable, long-term contracts.
Exactly. And those contracts are the mechanism that supports Sullivan's aggressive revenue ramp projections. We're not talking about making, 5 prototypes a year.
Right.
We're talking about scaling up to potentially hundreds of airframes annually. This designation just fundamentally de-risks the biggest piece of Kratos' future revenue.
Okay, so Engine 1 is reliable, mass production drone revenue, de-risked. But Kratos is more than just the Valkyrie. What's the second engine they're highlighting?
The second engine is what they call hypersonic dominance. The defense landscape right now is all about the race for high-speed capabilities. Right? And Kratos has secured its position there by winning a massive $1.45 billion contract for the NACHTB hypersonic test bed.
$1.5 billion. That's a huge amount of capital, especially for a company the size of Kratos.
It's enormous. And it places them in a really high-demand, high-tech niche. To be clear, MACHTB isn't just a facility. It involves these high-performance vehicles that act as test targets or platforms for new hypersonic weapons.
Yeah.
It's basically a flying lab at extreme speeds.
And the report describes the demand for this kind of testing as effectively infinite.
Yeah.
That's a bold claim, effectively infinite. What makes that credible here?
It's the geopolitical urgency. Yeah. The U.S., its competitors, everyone is pouring resources into mastering hypersonic flight missiles traveling at Mach 5 or faster.
And you can't build them if you can't test them.
You absolutely cannot. You can't develop or test these systems without robust specialized test beds, like MACHTB. It's a high barrier to entry field, and by winning this contract, Kratos is now a key strategic partner in a tech race that is not slowing down.
So this represents stable, high-margin revenue that's totally separate from the Valkyrie program.
Totally independent, yes.
Okay, so we have guaranteed mass drone production, and we have this high-value, high-tech testing contract. What's the third factor that accelerates this all the way to a 150 valuation?
The third engine is management's own aggressive expectations, and this is what really separates Kratos from its peers. Management recently raised guidance, projecting 15 to 20% organic growth for 2026.
Let's just pause on that for a second. 15 to 20%. Organic growth, that is. That's astronomical in the world of defense contracting.
It truly is. I mean, when you talk about the legacy giants, Lockheed, Raytheon, they're managing annual growth of maybe 3 to 5%.
If they're lucky.
Right. Their whole business model is stability and massive scale. Kratos, on the other hand, is projecting growth rates that are 3-4 times that speed.
And that's why the analysis says it's acting more like a tech stock than a boring industrial.
Exactly. You're not buying stability here, you're buying rapid, transformative growth. And that is what justifies the higher valuation multiple you need to get to $150.
But historically, how often do these aggressive defense ramp-ups actually hit their deadlines? I mean, the supply chain is notoriously slow. Is Sullivan just ignoring potential delays here?
That is the critical question, isn't it? Sullivan and JonesResearch are making a calculated bet. They're betting that Kratos, because it's smaller, more agile, more focused on these disruptive platforms, can move faster than the big bureaucratic legacy companies.
So the whole 150 thesis hinges on Kratos actually hitting or exceeding that 15 to 20% growth rate.
Absolutely. If they miss that ramp, the entire valuation model just collapses back toward the consensus. It's high risk, high reward, and it's all based on execution speed.
Which sets the stage perfectly for the market's reaction. If the fundamentals are really that solid, the market should have validated the news pretty quickly. So how did the trading action back up this crazy call?
The technical analysis here is really key because it reveals institutional conviction. We have to look at what happened on Tuesday, January 6th, the day after the target was announced.
The chart action was described as a textbook bullish signal, right? The dip and rip, a V-shape reversal.
A classic V-shape reversal. Take us through it. The stock initially gapped up on the news, which you'd expect.
Of course.
But then in the early hours, you had profit takers and high-frequency traders sort of testing the support. That selling pressure drove the stock down pretty sharply to an intraday low of $86.70 in the morning.
So the initial hype faded a bit, but it didn't stay down.
No, and this is the defining moment. Instead of selling off further, aggressive institutional buyers stepped right in at that low point, around the $87 level. And they just systematically accumulated shares all day long, ripping the price back up to close near the high for the session at $91.93.
That reversal is a huge indicator of who's in control. Is this just smart money covering shorts, or is this long-term funds building a position?
It signals that institutions, growth-focused mutual funds, hedge funds, are hungry for shares. They saw that dip as a gift, as an opportunity. It proves that major players believe the stock is undervalued below 90.
Right. If it was just hype, it would have stayed down.
It would have closed near its lows. The V-shape confirms that big money is validating the story, and they're buying every single dip.
So for anyone tracking the technical setup, let's nail down the critical price levels from the report. Where should we be watching?
Okay, the report highlights two key thresholds. First, the technical trend stays bullish as long as the stock holds above $85.
85.
That 85 level is sort of the foundational support. If it breaks below that, the bullish conviction is significantly weakened.
And what's the trigger point that confirms the run toward that $100 mark?
The second and more important level is the resistance at $93. Breaking above 93 is the signal that the analysis says opens the floodgates.
Okay.
That level is the recent consolidation ceiling. A confirmed break above it suggests the institutional buying has just overwhelmed any short-term resistance, paving the way for a rapid move toward that big psychological $100 plus level.
So that would be the technical validation that the market is officially buying into this new aggressive growth story.
Exactly. It's the market moving away from that 90 to 100 consensus and starting to price in the new model.
It makes the technical roadmap very clear. Okay, let's synthesize all this. So what does it all mean?
What we have is a powerful, integrated narrative. You have a credible Wall Street analyst issuing a target that's 60% above consensus.
A huge catalyst.
A huge catalyst. And it's driven by three measurable fundamental growth engines. That program of record status for Valkyrie, the massive hypersonic contracts, and management's own commitment to delivering 15 to 20% growth.
And the market, with that aggressive V-shaped buying, has immediately validated the idea that, hey, shares below $90 are just too cheap.
Precisely. So for you, the learner, this report frames KTOS as a really unique opportunity. It gives you exposure to the defense sector, but because of its disruptive tech and this aggressive growth forecast, carries the kind of volatility and potential upside you normally associate with a tech stock.
It's a high-growth defense play that really requires you to believe in the speed of their execution.
It's a compelling case, built on specific contracts and measurable technicals, but you have to acknowledge the risk that comes with banking on such aggressive acceleration. And since the entire thesis and that jaw-dropping 150 price target rests so heavily on that transition to mass production to hit that growth rate, where we have to end with a critical thought.
Okay.
This raises an important question. When you consider major defense programs, how quickly can a program of record realistically scale up production to meet aggressive revenue ramps like a 15 to 20% projection? And what unforeseen logistical or supply chain hurdles might that kind of acceleration introduce before that 2026 timeline?
Speed always adds complexity. That is a great question to keep